Good afternoon, everyone. It is Sunday afternoon, 3 p.m. Thank you so much for joining Money Matters today. I hope you guys had a good lunch. Hope you guys are well rested and having a good time on your Sunday afternoon. I think it's the beginning of the year. I think all of us are getting into gear for January, and I hope all of it is going smoothly and well for you. If you are new to Money Matters, welcome to Money Matters. So, Money Matters is a show that we conduct on a weekly basis where we cover various topics on personal finance, entrepreneurship, business, all of that. And why I do this particular show is because I am personally someone who likes to listen to people's experience and learn from those, right? Because I feel like the best way to avoid making too many mistakes in our own lives is to just learn from other people's experience, which many of us don't necessarily take conscious effort or time to do it. So here I am providing this one platform so that each and every single one of you have an opportunity to meet people from various backgrounds, listen to their experiences, their perspective, their stories, and pick and choose what works for you and what you would like to start applying. Of course, there are some sessions which is more experience based, and then some sessions where we'll really dive deep into certain topics so that we get an understanding. Because some of us may lack the basic knowledge about certain areas in personal finance, and I also want to help you guys bridge that gap. So I hope you continue not only watching today's episode, but join us for all of our future episodes on Money Matters as well. And for all of my returning subscribers who are tuning in, thank you so much, guys, for always being here. Do drop a hello in the comments if you're watching, and stay on to the rest of the show. So today's topic is something I've been looking for somebody to share about this on Money Matters, because I feel like not many people, surprisingly, are quite well versed on this. Which is credit, right? I think a lot of people that I personally know, the moment a student is done with university, a lot of them have student loans. There's a lot of them who have credit cards. There are a lot of them who have personal loans, car loans, house loans. But many that I've met are personally not really aware of like what makes you eligible to get credit, or what makes you not get credit. There are some people who have too much credit and they're not able to get it. So there's all kinds of different things to learn about in this area, and I've always been looking for somebody to share on this topic. And I think I'm very, very excited for today's session because of that. So today's session, we are going to be featuring an amazing speaker, Miss Selina Gabriel, who was the former head of consumer credit and retail credit at Maybank. So a little bit of background on her, right? I think she has 30 years of experience in credit and banking operations. I am like, that is longer than my lifespan. So that is how much experience she has in this particular area. And I think the expertise that she had spans from like planning, strategic planning, credit management, and all of that. And then specifically, how do they evaluate and assess loans, and like whether you get a loan or you don't get a loan. I think these are things that we don't really know about, but only people who are probably in the banking operations or people like Miss Selina would know. So we have a very unique opportunity today to learn from her, to understand how this works from her. And if you guys have any questions, you can drop it in the comments, of course. And so we will be discussing this with her. And I think not only does she know this well, she also has trained so many people in this area, and I think she continues to guide. And today, I think one of the reasons she has agreed to come and speak on Money Matters is also because she wants to, empower and guide youngsters out there as well on this topic. So without further ado, let's welcome Miss Selina on screen. Hi, Miss Selina. Good afternoon.
Hi, Madhura. Good afternoon.
How are you doing today? How are you feeling?
I'm good. I'm excited too, because I think your audience is a very interesting audience. These are the people starting on their financial journey,
Yep.
And it's interesting to guide them so they get it right, not make the mistakes that some of us have made along the way. So
Yes.
yeah, I'm excited too.
Thank you. Thank you so much for taking time to come and speak to us. I personally appreciate it a lot. I think today will be a very, very beneficial session for all of them. But before we go into our topic and whatnot, I personally like to ask some questions to my speakers just to get to know them a little bit more, get to understand their background a little bit. So the first most important question that I absolutely love to ask is, what is the biggest money mistake you have ever made?
Good question. I think what I did not do well, which I caught on and made some amendments to it, I did not do financial planning well. Yes, you earn money
Yep.
and you pay for whatever that you are spending on or whatever, but nobody actually taught us those days how to plan your financial journey so that the money that you have, yes, your parents will tell you, hey, money does not grow on trees, save.
Yes.
Yeah, you save, but saving is only one aspect. There is the investment and the growing your money and wealth creation. So this is what I didn't do well, and I think yeah, that is where I would like to share how to do it better.
Very nice, very nice. I think that is also the biggest money mistake many people out there have made, like not
Mm,
knowing about it, right? So
yes.
now that I think you have so much of experience and you've gone through, and I think you personally have learned and come out of it. From your experience, what would be probably one of the there's too many, I know, but one of the money principles that you personally adhere to and follow very diligently, and you also would advise other people to follow as well?
Okay. I would advise the principal thing that you must remember is, and I can't emphasize this enough, is you need to save. If you want to do something, you first have to start with the saving habit. You
Yep.
earn money, and if it goes all out spending and you have nothing held back, then there's nothing you can do because you don't have that reserve to
Yep.
start your financial planning or your wealth creation. Those days, I remember we were like a herd mentality. We will listen to hearsay, we will listen to market talk, we will be influenced by agents or or advisors, and just put your money here and there. You never planned it, what you want to do with your money and how you want to grow your money. Because if you save and you put it aside, that's you're just going to get interest from that savings. But if you know how to invest your money and do investment link savings, you can grow your money over time, and then you will see that few years down the road you have a pool of money that you can use for whatever you want to do. So you need money to make money. So I think I cannot emphasize enough that saving and saving prudently and investing it prudently, I think that is the principle that I learned the hard way when I saw my money going down the drain by making wrong investments and all that. And I would say that saving money is the most important. That is the principle that I think I will share with anyone. Before you
Yep.
do anything, start saving. Don't
Yep.
spend first.
I completely
Yeah,
agree. I think many of us
yeah,
uh, don't. I mean, we underestimate the value of this habit, right? The savings habit. If you get that right, you
yes.
can do a lot of things.
Because the trend these days I've seen is impulsive spending. It's buy now, pay later trends.
Yep.
If this is not well managed, what's going to happen? You're going to go down a slippery slope, and which will lead you to financial distress and
Yes.
also other consequences that you don't want to be, like bankruptcy is the worst consequence, right?
Yep.
So this trend that I see very common these days, swipe your card or swipe pay or buy online, I think
Yeah.
it has to be well managed.
Yep.
This is the
Agree.
trend that I'm concerned about with the younger people, especially.
Yep.
Yeah.
So you brought up the buy now and pay later. So I think that kind of leads us very nicely into our topic of today, credit and whatnot. So like for people completely probably like fresh graduates who are watching this, or young adults who have just entered into the workforce, who absolutely have no idea how any of this works, probably some of them don't even know what credit means. Either way, how what are the things we should know about with regards to credit, like what is credit and how does one use this tool?
Okay, credit is a very wide topic, but
Yes.
today I would like to focus on the 5 C's of credit,
Okay.
which everybody should know about the 5 C's of credit. which is what the banks use to assess your credit worthiness. It's a principle of 5 C's. The 5 C's are character, capacity, capital, collateral, and what's your last C? Conditions. So these are the 5 C's of. But for a consumer, if you're coming to the bank to get a credit card or a personal loan or even a hire purchase loan, for a consumer, it will be the 2 C's. The most important is your character and your capacity. Okay. Now, can I just explain a little bit on what's character and what's capacity?
Yes, sure. That'd be great.
Okay. So now, character is actually the banks assessing you to see, will you pay back the loan that you took? Okay. When the banks lend or financial institutions lend, they must be able to assess your character to be able to say that I trust you with this amount of money. Will you pay me back diligently, regularly, or will you be a bad paymaster? Okay,
Yep.
that is the character. So can I trust you with the money to settle the debt obligations on the due date? That's character. Capacity, on the other hand, is whether you have the cash flow to pay. Capacity is whether you have the cash flow to pay. You may be able to take a few loans, but subsequently, if you want to increase your borrowings, we must be able to see whether you have the cash flow, and the debt service ratio will show whether you really have the capacity to pay. So that's the cash flow thing. Now, let me come back to character. How do you depict character?
Yes.
How do you depict character? Now, character in the current world, currently now, you have a credit scoring. Okay. This credit scoring is it's global scoring, originally developed by FICO, and that credit scoring is a global benchmark to assess you on a scale of 300 to 850. So you will have a credit score for every individual who has a credit history, and that credit score will depict currently with the loans that you have taken how good a paymaster you have been.
Yep.
So if your score is higher, that means you are a better paymaster. So you go from poor to average to good, very good, and excellent. So that credit score, which is determined, the determinants of your credit score, there are 5 key determinants of your credit score.
Okay.
How do they arrive at that number, which is actually a statistical data analysis of your probability of default? So 300 to 850 shows a number whether you'll be a good paymaster, whether you'll be a tardy, you will have tardiness, or you will be the kind that will not care less about paying your loans. So what are the things that goes towards the score will be once you have a credit history. A credit history, let me explain, is when you have first taken the first loan, whether it's a credit card, whether you have taken a car loan, the minute you create your first loan. And these loans are in the banking system, financial institutions. You will start a credit history. Okay. So the scoring that at any one time that you have a credit scoring on yourself, you can get your credit scoring if you go into these credit bureaus like CITOS, they have a credit bureau. So you can buy your credit score. That credit score is derived from your payment history of the loans that you've already taken from the banks. It is also taken how long you have been a borrower. So the length of your borrowing and the total amount that you have borrowed, the total amount you have owed, the type of loans you have taken. So if you have been taking just credit cards, clean loans, when you take clean loans, there's no collateral based, whether it's clean loans or you're taking secured loans against collateral like mortgage loans. That, and the last one, which is key, is how soon do you take your loans, how you ram up your loans. Like if you take a credit card and then you come 3 months later, you go take a credit card with another bank, and then a few months later, you come and take a car loan. Within 6 months, you ram up your borrowings. It will affect the scoring. So the 5 key things that will actually determine what is your score will be your payment history, your length of credit history, total amount owed, the type of facilities that you take, and the new credit taken. Now, the type of facilities that you take will be, are you just taking credit cards or unsecured loans, or are you coming for mortgage loans? Or are you like leveraging on overdrafts? Are you
Mm.
leveraging, or are you
I-
just taking personal loans?
Is it
So
is
these
it
are
that clean loans are considered like not as good as having those secure loans in a way?
Uh, yes, because there's a no second way out. When I talk about the five C's, there was the capacity, the character, and then
Yeah.
there's the conditions, there's the collateral, and the collateral is the second way out.
Yep.
Second way out means if you buy a property and you charge the property to the bank,
Mm.
in the event you default, I have a second way out because that property is actually charged to me. I can
Yes.
foreclose on the property. So that is a secured loan. A clean loan is like a credit card. If you
Yep.
don't pay, there's no fallback collateral where I can recover unless I go
Okay.
for you and make you a bankrupt
Yep.
and try to recover from your assets. So there's a difference. And it has, of
Okay.
course, got different risk levels. A
Yep.
secured loan versus a clean loan.
Okay.
Yes.
Okay. Okay.
So that's how you derive your credit
Credit score.
scoring. Credit
Okay.
scoring. So your first C, which is character, is determined by your five things that I just talked about.
Yep.
And what it actually depicts, character depicts, is how good a paymaster you have been. How good a
Okay.
paymaster you have been. So if you have a good record, the probability of you defaulting on future borrowings when the bank wants to consider to give you additional loans or you come for your second loan or something, the probability whether you will default is depicted by the character that you have shown in your credit history so
Mm.
far. Okay, but capacity is a different thing.
Yep.
Capacity means, do you have the cash flow for additional borrowings? If you have been a good paymaster for what you have already taken, that means your cash flow was sufficient. But when you come for additional borrowings, do you have the cash flow to take on the additional borrowings? That is how the banks assess your capacity. And capacity basically is assessed. You have your should I say your salary, your
Yep.
basic salary, your and then you will pay your mandatory deductions like your EPF and your SOXO. Then you will have your net income. So this
Yep.
net income is what you have available for your use. And it's from this that you are going to pay your debt repayment and also your cost of living and your savings.
Yep.
So you have three components here. So how much of this net income you can use for paying loans? You can't take everything and say, I got so much. If let's say your mandatory is about 20%, your
Yeah.
80% cannot be all for paying loans, then you've got nothing to eat or
Yes.
not for your overheads. So the banks are regulated by our central bank
Okay.
based on the income. There's two categories of people. There's the vulnerable segment, and then there is the non-vulnerable segment. So our regulators have actually kind of controlled this by saying that do not over leverage the vulnerable segment. That means we have to be very careful that of the net income, only 40% can go towards debt repayment.
Okay.
Only 40%. That leaves them a 60% of their net income for their cost of living. The cost
Okay.
of living, when I say cost of living, will be your what should I say, your food, your lodgings, your healthcare, your transport, your payment of utilities,
Yep.
your socializing, your recreation, all those things. Okay, so that
All
is
right.
your healthcare. I mean that's your cost of living. So you will leave 30% for your cost of living.
Okay.
You'll leave 60% for your cost of living and only 40%
40%.
for this segment. There is also another rule that our regulators have put in, which says net disposable income. Okay,
Okay.
so if let's say you have 80% of it, let's say you're earning 5,000, and after you pay your statutory deductions and all that, you've got 4,000 or maybe 3,000. From that 3,000, only 40% will go towards your loan.
Yeah.
But if your income is so low and that 40% leaves you hardly anything, your 30% is just $100 or
Yeah.
$200 or $300. It's not enough. So they
Yep.
have put a benchmark to say your net disposable income you must have a certain range of net disposable income, which will depend on which area you live in, urban, suburban, or rural areas. Because
Okay.
definitely when you're living in urban areas, your cost of living is more expensive than rural areas.
Yeah.
So there is a two rule thing. You must not have a service ratio of more than 40%. But on top of that, you must have net disposable income at least 1,000 or 1,500, depending on how the regulator has put it in, to say that your remaining 30% or 1,005, whichever is higher.
Okay. Okay.
Okay? So
Okay.
that's for the
You
vulnerable segment.
Yeah, you mentioned vulnerable segment, right? So who is categorized into the vulnerable segment in a way?
Currently in Malaysia, those who are earning 3,005 and below household income uh, is vulnerable segment.
Vulnerable. Okay. Okay.
We cannot over leverage that, because if there's anything that is exactly what happened like COVID now, when
Yes.
you lose jobs or your salary gets cut, or for some reason your business, the whatever you're doing is affected, you don't
Yeah.
have a buffer. You're going to
Yep.
suffer, as we saw it in real life. You're going to
Yes.
suffer. So it's because of that there's some kind of protection, so that the lenders don't become predators lah.
Okay. Okay. Makes sense.
Yeah.
So for the ones who are not in the vulnerable segment, how does it work for them?
Okay, for those that are not in the vulnerable segment, that means I would safely say that most of the new jobbers and all that first jobbers, those fresh graduates, they probably are not in the vulnerable segment if they're earning more than 3,005. For
Okay.
for this category, the debt service ratio can go up to 70%. Okay, but this is all the loans taken together. That means your credit card, your
Yep.
ASB loans for the Bumiputra borrowers, then your car loan and any personal loan, mortgage loans, all in can go up to 70%. So you are left with 30% for your cost of living, but
Okay.
there's no net disposable income imposed for them. So it's
Okay.
70% maximum goes towards loan repayment, and the other 30% is for your cost of living.
Yep.
So
But
yeah.
on your personal experience, right, Miss Alina, like if you were to recommend people on how much they should leverage, should they be going for 30%, or like if because they have the capacity they should push all the way to 70%, or should they have some percentage that they keep it with so it's manageable and doable enough?
I strongly believe you cannot go for 70% unless your 30% is very sizable.
Yep.
Okay, so those who are not in that category, yeah, the ones that are in the category, let's say you're earning less than 10,000, if you push, let's say your net income is only 8,000, and you push up to 5,600, 70%, I think is about 5,600. You
Yeah.
don't have much for your cost of living, and if you are married with children, dependents, you have elderly parents living with you, and you have got a lot of other commitments. Some of them have their education loan, some of them have other medical needs and all that. 30% is not enough. So I would suggest that for individuals who are starting off, perhaps you should put a lower percentage on yourself. You should self-assess. Can I pay if I commit for this? The
Yep.
banks will give it to you, because working the arithmetic, you qualify, yeah. But you yourself need to assess what happens if something goes wrong. Exactly what happened during COVID. If something goes wrong and I get a pay cut, do I still have the buffer to manage? And over and above, what we need to do is, we must remember, while we take our loans and while we are doing our cost of living, paying for your day to day, you still have to grow your money. You still have to put a small amount back for savings. So
Yep.
if you have 70/30, then where is your savings coming from? So I
Yep.
would suggest, maybe, put a lower margin and then save. The
Yep.
beginning years you have to save. So your question, I think not really. I think don't hit the maximum.
Yep. Yep. Makes
Keep
sense.
your buffers. Yes.
Yeah, it will be deeply troublesome if you do go for all the way. And
Yes.
I think there is, so you spoke about capacity, and I think this the other thing is character. So for for y- I personally know some of the freelancers, like the youngsters I work with. I think that's the new thing now. A lot of youngsters are looking into going into freelancing, gig economy, and all of that. And they personally have had this concerns. Like I personally have met people who have concerns that they can't show their character in a way because they don't have a salary slip that shows this how much they're earning and whatnot. So for individuals who are going into this industry, how do they display the character in a way?
The character is you paying your loans on the due date.
Okay.
Okay, they can display the character.
Yeah.
What they cannot display is the capacity. They cannot
Okay. Okay.
show whether they have the capacity to take on
Okay.
additional borrowings. I think this is a problem on both ends. I think the lenders also have the same problem. How do we assess you to give
Yep.
you, especially if your loan is a long-term loan and you are in a gig economy, and whether or you are in a small SME, or you're operating your own business from your home, the small
Yep.
timers, uh, it is a challenge both for the
Okay.
lenders also. It is a challenge, but I think as more and more I see the younger generation, especially going into this, I want to be financially independent. I want to do my own thing. This is my passion. I want to do what I love doing. I don't want to go and sit in an office and do a boring job.
Yep.
This is the sentiments these days. Yeah. So what I would think is, for me, I've come across a lot of this where you are not able to show your money trail. You're not able to show what you earn and what you spend.
Yep.
So to start off with, you don't have documents. You don't have documents. And our regulators say that we can't lend if you don't have income documents to show your income. If you're gainfully employed, that means you're salaried, gainfully employed, of course, your income documents can be easily verified. But for those who are self-employed, whether you're a registered uh, self-employed SME where you're operating in premises out there, they're your brick and mortar premises,
Yep.
or you're operating on this wide space internet and online trading and whatnot,
Yep.
wherever you're operating, I think the first step is for you to show your money trail and your cycle, your money cycle. So whatever that you are making, whatever money you collect must go through the banking system. That means what if you're a cash sales, you cannot just take and pay your supplier cash. You need to put it through the banking system. So there is very clear, should I say, evidence that this is the amount of inflow that you're getting,
Yep.
and then your outflow should be paid very it should be very well shown where your money is going out. So when
Yep.
your inflow every month, you show an inflow whether you're collecting it daily or weekly or monthly, and if you show an inflow of 10,000 or 20,000, and then you show your outflow every month regularly, you're paying out 18,000 for your suppliers, for your overheads, then you can show your profit of 2,000. And that's the first thing. You must be able to show the cash flow.
Yep.
Two, you must be paying tax. You
Yep.
need to start paying your taxes. Okay, because once you declare to the authorities, it shows that you have a legitimate business, and you're declaring. Whether you pay tax or not, I do not know, but you declare.
Fine.
You
Okay.
declare your taxes. Okay, you may
Yep.
be incurring losses and so not paying your taxes, but you have to declare. So with this too, I think it will make it easier. I won't say it's so much easier, but it'll be a first step to say I am serious about running this business. I'm creating all this, and eventually I will be able to show the bank that I am stable. What the banks are concerned about is whether your business is stable, whether your cash flow is sustainable. That's
Mm.
that's very important, stable and sustainable. So if one day you put in the money, one day you don't put in, and then how do the banks establish that it's a stable and sustainable source of cash flow to repay your loans? So
Yep.
that's important. Yes.
That makes sense. That makes sense. Like don't do business for 1 month and then not have anything for the rest of the 2 months and then come back again. Don't do that kind of stuff. Makes sense. I'm personally curious, right? Like, every does student loans affect your credit score in any way? Does it reflect on it? And like, because I know a lot of people do that. Like for in Malaysia, we have PTPTN, so they can do the Ujra and like postpone it by 2 years and whatnot. Does that reflect on their credit score?
Yes, it does. Yes, it does. Yes, it
And
does.
and does the postponement actually like make it like actually indicate like not a good indicator in a way?
Well, basically, when this whole thing blew up in a few years ago, the PTPTN loans were onloaded into the Secret platform.
Okay.
I think that was done a couple of years ago. Before that, it was under the radar whether you paid your student loan or not. But then
Okay.
when they uploaded, what happened is there were borrowers, students who had not paid for 5 years.
Yep.
So, it shows in the 12 month, you have 5 years is like 60, 60 repayments overdue, 59, 58, 57. So
Oof.
obviously your scoring is going to go
Okay.
out.
Okay.
So
Yes.
there was a hue and cry. There was two, I mean, to be fair, you were supposed to pay your loan obligations. But there was a
Yep.
school of thought that said that the lender didn't come after me. So I didn't pay because I didn't know I had to pay. I'm not alluding to either one of this, but I'm saying that when it first started and it got onto the Secrets platform, it affected the scores. Definitely, it affected the scores. I think subsequently, because lenders also are in the business of lending and they need to make some allowances, they did make some allowances to say that student loans, if the borrower goes to the lender, I think the student loan PTPTN, and make an arrangement to repay and they have an acceptance letter, then that loan was excluded from the scoring.
Oh.
If not,
Okay.
you're never going to get a good scoring. Even
Yeah.
if you have a 40 secrets, you didn't pay like 1 month or 2 months in 12 months, spotty secrets, or you are a regular defaulter. That means every month you are 1 month overdue.
Oh.
Okay, that
Okay.
means
Yeah.
when you look at your secrets, the 12 months is 11111. Sometimes people have 000. That means you're on time, and then suddenly 1 month you forgot to pay.
Yeah.
All this affects your score. What more when you have a loan that is 60 months overdue?
Yeah.
Definitely affects your score, and nobody can lend because the risk for the bank is very high when they lend with poor credit scores. Two, for the borrower, if it's risk-based pricing, your loan that you come to, you're a student, you have a student loan, and then you come to get a car loan or a housing loan, a mortgage loan, your interest rates will be much higher because of your poor credit rating. So
Yep.
it really cannot. So I think banks have made an allowance with consultation with the regulators and all that. But
Okay.
having said that, for those new ones that are coming on board, the new that was at that time, you definitely have to pay your student loans. You
Yep.
really have to start from day one, making budgeting to pay your student loans. You cannot ignore your student loans. So if you are taken and then it says 1 month after you get a job, I don't know how student loans work. 1 month after you get a job, then you should start going to making an arrangement to deduct your account and pay. So
Yep.
that's good credit management for yourself also.
Yep. I think that also is a way for you to start setting up your credit history in the right way. Because one of the things that when I first started working, the first thing that many of the adults in my life told me is you must have a start building your credit history so that in the future you'll be able to get it. So if they don't have a student loans to get started, what are the other ways young people can make sure they build up their credit history?
As soon as possible, you must surface into the credit world. You must surface. You cannot be under the radar. I have seen very few people who are still under the radar. This will be just two categories of people. Those who really are not credit worthy, they cannot even go and get a small loan. So you really cannot start a credit history. And those who have born maybe with a golden or whatever spoon, where your father is paying for everything and you don't need a credit card, even a credit card. So that is just two ends of the spectrum. But in the middle, everybody needs to start your credit history as soon as possible. So the first thing you will start off with will be a credit card. That's if you have an income. I'm not sure what is the minimum income for credit card, but once you're eligible, start your credit history by taking a credit card. Okay, and
Yep.
then subsequently, I'm sure most youngsters will want to buy a car. So your next loan will be your car loan, and then for the Bumiputra uh, the Bumiputra community, you will have the ASB loan. So they will start with an ASB loan because the returns are good and all that, and it's really good to take your ASB loan. So they will start with the ASB. So for the non-moving trust, you will start with your credit card, and then probably you go for a mortgage, not a mortgage, a HP, hire purchase, and then a mortgage later on. So this is how you build your credit history, and you must build your credit history, because if you don't have a credit history, they cannot score you, and if you don't have a score, it's very difficult to get a loan. If we can't score you, so it's good to start a credit history as soon as possible. Having started the credit history, then you must be responsible enough to make sure that you pay your commitments on time. So if you know that you are due to pay, please budget and set aside your money, or put a standing instruction to pay your loans. So starting a credit history is very, very important, and keeping your credit history clean is also very important, equally important. So these are the two things that I think they should all start off with.
Yep. I think only recently I went and downloaded. I mean, you have to purchase it. I purchased my CTOS report. And I was like, okay, so this is my score and all of that. I think that is also one of the things youngsters can do, right? Actually keeping an eye on your credit reports, credit score, and all of that, and see how you're progressing. Is there other things that will get affected if the credit score goes wrong in a way?
Other things are, the first thing is, like I said, you start your credit history, pay your loans.
Yep.
When you have a credit card, let's say you first got a credit card, you get very excited because now you have, I don't know,
The ultimate tool.
20,000, and you tell your friends, let's go shopping. Swiping your cards is very exciting to be able to swipe your cards, not knowing how much you're spending in a day, how much you're spending. So I think that's a no-no. What you should do is, once you get a credit card, you must first set up your budget. How much you want to spend. And the rule of thumb is, you don't spend anything that you cannot pay with cash. That's the rule of thumb. Okay.
Yeah.
If you can pay with cash, let's say on the first you want to go buy something, but you know that at end of the month your salary will be able to pay for that, then swipe your card and make sure you pay the full amount. So you can. Normally they give you 2 or 3 times your salary, isn't it? So you cannot spend. You cannot spend because you don't have that capacity to repay. But I think that's what's happening anyway. But to be prudent, you should only spend what you would be paying cash for, and you should pay the full amount at the end of the month on the due date. Pay the full amount. And don't utilize your card to the hilt. Normally, those days when we taught our people, when we taught training, we say don't use more than 30% at any one time. That's the safe percentage for yourself. So if you have a credit limit of 10,000, maybe at any one time your outstanding should not be more than 3,000, and probably you should be paying off that amount. But even if you don't have the money to pay off the full amount, don't skip a payment. Pay your minimum amount. Because if you pay the minimum amount, your credit your credit record will still be good. You pay your minimum amount. But what happens is you're just accumulating. You're just accumulating the debt, and then it's definitely going to snowball, and then you can't pay. So don't. And the other thing you shouldn't do when it comes to credit card is, you take credit card from this bank, then you go to another bank and then you go into the shopping mall, somebody offers you a credit card, you take also, so you have 3 or 4 cards, and then you spend all your cards, and later you realize, hey, I need to consolidate these cards, and you pay down one card, you close a card, then you pay down. That's not the way to manage cards. That's not the way to manage cards, because the minute you start closing cards, your percentage of loan, that is, the thing that affects your credit scoring. Your credit scoring will worsen when you start closing your credit cards and consolidating. You must be very careful how they do it. So I suggest, don't take so many credit cards. Live with one credit card and don't use it to the maximum, and pay off on due date. Try to pay the full amount. And even if you don't have the full amount, pay the minimum amount, but don't skip a payment. And the charges on credit cards, if you skip payment, is quite substantial. and that will snowball. That will snowball. Of course, the banker or the institution that gives you the card, they are in the business. They want you to use the amount. That's why they're giving you the limit. But I think you need to be prudent and you need to self-assess whether you can afford it and whether you need to use it. It's a standby credit for emergencies. Other than that, don't swipe, don't go down that slippery slope.
Yes,
Yeah,
yes. I didn't even realize that consolidating, and because I know a lot of people who do that, right? They get the other card and then settle this card, and that's what they do, and that affects your score very badly. So speaking of people who can't manage their credit, who already have it and they are unable to manage their credit, what can they start doing? Because I know some people who have a lot of debts and they are not able to pay this, so they're just trying to settle a few and then not paying the rest. So what is the best way for people who can't settle their loans or pay even the basic minimum payments? What can they do?
Yeah, they can do a lot. They can. Wait, just before that, I wanted to also tell you something. So we were talking about credit card. Pay your credit card on time. Oh yeah, this is what I wanted to say. You know, when you get your bill at the end of the month, just don't
Mm-hmm.
pay. Take your statement and scrutinize it. Go through every item and see whether you really did spend that. Because
Okay.
nowadays there will be many, not nowadays, all the while, you if you don't, there may be some places where your card has been cloned or there was charges that you didn't swipe your card for that, but it got swiped some other,
Yep.
and you need to check before you pay. You cannot just simply pay. It may be small amounts, it may be big amounts, but you must keep a tab. You must keep a tab on your statements and look at it every month before you pay. Personally, I got affected once when I got my statement and I saw that I spent 11,000 in Dubai when I was sitting in KL. You know, and that's a big amount. So immediately it
Yeah.
will catch my eye, right? Then I
Yeah.
realized it was my supplementary card. My son had traveled through Dubai airport and used it to buy, I think, a coffee or something, and the card got cloned.
Ooh. Okay.
But then, of course, these things, when you prove that you did not use it, you can always claim it back. But if you don't claim it back, then you're going to keep paying for it, especially
Yep.
those who just pay 10% or 5% every month. You just, this is a minimum amount, I just pay and, get through it without looking at your statement. So
Yeah.
I would strongly advocate that make sure you look at your statement and ensure that you actually made all the purchases and then you pay. And that is also good because then it'll give you a shock. Hey, did I spend so much this month?
Yeah.
Suddenly
Yeah.
you look at it and say, wow, what did I spend? So
Yes.
I suggest that do that. Mm,
Yes. I
yeah.
think when we go, I highly recommend people do the monthly financial check, review your
Yes.
finances. So please do check your credit card statements also during that period of time.
Yes.
It's very good.
Yes.
I think
Yeah.
now I forgot the question I asked
No,
earlier.
you asked what to do when you are over leveraged, you spend so
Yes.
much on, and you do not know what to, know how to come up with. Of course,
Yep.
when you realize that you are in distress, when you see you can't pay, your bills are mounting, you don't walk away from the problem. Face the
Yep.
problem. You know what people do? They just walk away and they think that the banks will just write it off. They're not going to write it off. So
Yeah.
then one fine day you wake up and you find yourself a bankrupt or something detrimental like that. So instead of going there, because to reverse a situation like that is very difficult. Once you have that what should I say, that red spots in your credit history where you have been a poor paymaster to the point that the bank had to take action against you, it's very difficult to reverse it. It'll take years to reverse that situation. So what I suggest is, if you find yourself feeling this, not only because of overspending, because your income has been affected by something or other, seek help. Go to your banker, go to the one that lent you, and try to work out. They can help you up to a certain extent. Okay, if you had not, if you're not waited too long.
Mm.
But the other thing that you can seek is, you can seek not sorry, counseling, credit counseling from agencies which are set up by the government. Like one of it is AKPK. AKPK is under Bank Negara, where they will counsel you and teach you how to restructure and redo whatever needs to be done for you to come back to the normal flow. It'll be
Yep.
painful because then you will have to cut your spending habits. You may have to cut a lot of your, what should I say, your standard of living, your
Yep.
lifestyle. You have to cut, but they will guide you and teach you how to get back out of the red. Okay, so don't wait until it's so late that legal action comes in, and then the legal process takes you and puts you into a position where you are deemed not credit worthy anymore.
Yep.
Very difficult to come back into a better situation. So I suggest that for those who are already feeling the distress, or in future you have financial distress, go to your banker. Of course, for the younger generation, you need to talk to your parents. They can guide you. If
Yep.
not, go to the bank and they can guide you, or go to the counseling agencies which are set up for this purpose.
Okay. Okay. Very nice. I think we are also coming quite close to the end of our time. So I just thought of asking one last question.
Yeah,
Some of the
okay.
ones who are viewing are like school going students, and they may also be parents who are watching here. So for those who are in school where this thing is not yet a problem, credit is not even a thing in the radar yet, what can they do to get, what are the things they should be learning about, so that when they come to that age of where this becomes a concern, they are well prepared and able to handle it.
What parents should be guiding their children? Um, Firstly, I think you should teach them the value of money. You cannot
Okay.
indulge your child. You cannot indulge your child
Yep.
and give them the false impression that everything is hunky dory out there, and money is so free flowing that
Yeah.
whatever you want, I can buy you. So don't
Yeah.
worry. No, I don't think so, because you are creating adults future. You are nurturing future adults, and you're going to put them into a system. You're
Yep.
going to put them into a system, the banking system, where then later on they will have to stand up and also be able to do things for themselves. So I suggest from day one, discipline where money is concerned, and also teach them the saving habit, and
Yep.
also teach them how to start small investments. Small investments. Um, it can be small things. It doesn't have to start big. Maybe you want to say, if you're good in something, why don't you just do a small home business?
Yep.
A child of 15, maybe you can even bake cookies and sell, earn your own money. And
Yep.
when you have the money, teach them how to save.
Yes.
Those days we put in the piggy bank, huh? But now there's a lot of other things, other places where you can save. Teach
Yes.
them the value of savings. And I think if you do that as a parent, you can take them a long way, rather than just, there's a saying that if you give a man a fish, you can eat for a day, but if you teach him how to fish, he can live for a lifetime, right? Something like
Yep.
that. So I
Yep.
think that's the role of our parents. Okay,
Okay. I think that's a very, very nice ending. Thank you. Thank you so much, Miss Salina. I think one, as a young adult myself, I myself have gotten a lot of learnings from this session. And I think the ones who are viewing will also be a bit more careful and wary of what they are doing, what are the actions, the consequences of the actions when it comes to this area, and make better decisions, hopefully. So thank you so much for taking your time to join us today.
yes, thank you for having me on your show.
Alrighty. All right, let me just remove. All right, guys, that is the end of Money Matters. I think that was a very, very nice session. I personally enjoyed it a lot. What I would like to ask you guys is to share this episode, because I think this topic, credit, and how to manage it, if things go wrong, how to make sure things don't go wrong, all of these very important things that we should be learning about. But many of us don't have the exposure at a young age, and we may not know where to go and learn about these things. So if you know a friend who did that whole thing of getting 3 credit cards, or you know a friend who is struggling with paying off their things, just send them this video, send them this link, and ask them to check it out. You never know who you may help, because many of us get started because someone else thought of helping us out. And so just share out, make sure your friends and family are watching this, and I can assure you it will benefit them as well. And thank you for staying till the end and watching Money Matters with me. And I hope you guys join our future sessions. We have a lot of exciting topics and speakers lined up. And if you'd like to subscribe, you can actually subscribe to Money Matters. The link is in the description. And I hope to see you guys in our future episodes. Thank you so much, guys. One last thing is, I've also recently published my book. You guys can actually check out also Money Matters. The book is also called Money Matters. It's the printed edition is currently available in Malaysia. So if you're interested to get a copy, you can check out my website, madrake.com, or you can also check out ascendancepro.com, which is the youth movement that has facilitated my growth so much, as well as a lot of other Malaysian youths' growth as well. So thank you so much once again for joining, and I'll see you guys next week. Thank you so much for watching, and please do like and subscribe so that you never miss an episode. Do share this episode with your friends and family. And if you like this episode, leave us a review on our Facebook page, facebook.com/simplyempowering. Money Matters is where we aim to provide valuable content to inspire and empower you on your money matters. Thank you once again for watching this episode, and see you guys at the next one.